Good morning, everyone. I know we had about over 80 people registered for the Zoom, so I know some people will be popping on probably late. So I'm going to just give it about 2 minutes, and then I'll introduce our speaker today and introduce a topic that I think is exciting. Because I know up until a few weeks ago, I was looking for the information about opportunity zones, and then I connected with David, and he's a wealth of knowledge on it. So I'm excited to introduce him and get everything started. So we'll probably wait about another 2-3 minutes while people are hopping in, and then we'll get started. Like I said, more people are going to be popping in. So, I want to get this started. Like I said, we had about over 80 registrations. So I know we're going to have more people popping in. But thanks for everybody joining us. Today, our topic is we are going to be discussing opportunity zones. Opportunity zones is a fairly new program that came out over the last few years, which appeals to a lot of investors. And now with the 1031 exchanges, talking about being on the chopping block with some new tax programs and whatnot, that we think this is such an important topic for you guys to know about, to one, if you're an investor yourself, or two, to be educating your clients. So again, thanks everybody for joining. I see more people are hopping on, but I do want to introduce David Silliman. David is the head of Easy Do It, and he's known as one of the top authorities on opportunity zones in the country. So I'm excited for him to take time out of his busy schedule. So that's why I want to get started, because I know he's busy and he's doing this for us. David, how are you? Thanks for joining us.
Hey, Carl, thank you. Thank you so much for having me. It's an honor to be here. I apologize for the background. I'm down here in Florida. I had a family emergency. We had a passing of my grandfather yesterday, so I kind of caught the red eye out. And so I'm sorry that my background's a hotel room.
Oh, we appreciate you being able to do this. I'm sorry about your
Yeah,
loss.
thank you. But I wasn't going to miss this for you, Carl.
So David, I kind of want to just, if you want to introduce yourself and kind of start breaking down opportunity zones.
Sure.
If you have any questions, you can pop them in the chat and we'll definitely get some Q&A going.
Sure. Welcome, everybody. My name is Dave Silliman. I'm the CEO of a company called Easy Do It Opportunity Zone Funds. Also, ozfunds.com, opportunityzones.org, ozadvisor.com, ozvoices.com, and a bunch of others. But needless to say, my background is very, very heavy in the opportunity zone space. A little bit about kind of our company and what we've been able to do. We actually set up the second opportunity fund in the country to ever open. We also did the first business-based opportunity zone fund in the country to ever open. And so pretty much been involved at the national level from day one. I was one of the economic advisors that sat on the Top Opportunity Program, which is a joint program with the U.S. Census Bureau, Office of the President of the United States, and his economic advisors on the Opportunity Zone program have had an honor of basically speaking from every major stage in the country on opportunity zones, every tax conference, every Novogradac conference, Tax Policy Institute, International Economic Development Coalition. The list goes on and on and on. But opportunity zones, it's a program that, it was established in 2017 under the Tax Cut and Jobs Act. And it is a massive, massive program that has already seen in excess of just under $200 billion already invested into it. And what the program is, very, very high level. So I'll go high level and then we'll stand on the moon, look at it, and then kind of drill into it a little bit and open up good Q&A and so forth. But the idea is that this program was designed to privatize economic development in what are classified as designated opportunity zones. So they're basically opportunity zones are classified as low-income census tracts. They make up 25% of all the census tracts in each state represents an opportunity zone. So there's 8,700 opportunity zones themselves across all 50 states, Guam, U.S. Virgin Islands, and virtually the entire island of Puerto Rico. So everything that falls within those geographic areas, especially real estate, is what this is designed to be able to have an impact. And so it's either ground up development or taking an existing property and rehab. And it works for all types of real estate. It's not just apartment complexes or hotels. We can go all the way down to little ADUs, and it works in that, to single family, etc. This program was backed with bipartisan support. A lot of people don't know that this program actually originated under the Obama administration. It was the Trump administration that kind of took it and ran with it. But what this program does is it offers significant tax benefits to capital gain holders who choose to reinvest originated capital gains into what are called opportunity zone funds. So the fund is the vehicle, does all the reporting. And then from there, the fund takes the money that is invested into the fund and then reinvests it into zone designated assets. So real estate, businesses, things like that. So the idea is to let's incentivize the capital gain money and give tax benefits to incentivize that money to actually utilize this program. So the tax benefits are extremely lucrative for capital gain individuals. The very first benefit, and there's three major ones that impact investors who have capital gains. The first benefit is normally when you have a capital gain event, you're going to be responsible for claiming or paying capital gains taxes on that capital gains at the end of the year when you go and you file your taxes, right? What this program does is the first major benefit of three is it says you don't have to pay that today. You don't even have to pay it next year. You actually can defer that payment all the way out to tax year 2026. So do fiscal year 2027. So if I had, let's say I sold a property and I had, a $100,000 capital gain event, right? Instead of paying my state and my federal taxes, depending on what state that you live in, this is also matched by 45 out of 50 states at the state tax level as well. So instead of paying that tax, I defer that all the way to 2026, due tax fiscal year 2027. Second benefit I get besides the deferment is I'm going to get a step up in basis on that tax that's due. So when I invest my $100,000 capital gain into what's called an opportunity zone fund, all right, if that $100,000 example, come 2026, instead of paying capital gains tax on $100,000, I'm only going to pay capital gains tax on $90,000 because I got a 10% step up in basis. So that's the second benefit, is the step up in basis. The third major benefit, and this is where all the magic happens, is year 10 and beyond for investors. And that's an investor gets a full step up in basis to fair market value at time of exit. So what does that mean in plain English? It means that if I had sold a property and I had a $100,000 capital gain, and I rolled that capital gain into a fund, and then I found another property, and that 100,000 went into a new property, all right? But 10 years later, let's say I exit, and now I've got $1 million. So I had a $900,000 increase on my $100,000 basis, right? Well, when I go to flip that or exit out of the opportunity zone fund, that $900,000 increase, I pay zero capital gains tax on at all. None whatsoever. I only pay capital gains on the originating capital gain money into the opportunity zone fund. Now, beautiful thing about this program is that when you look at how it's designed, all right, so you have basically for investors, it's a 10-year program. The reality of it is it's a lot longer than that because the program doesn't expire until December 31, 2047. Which means that I can ride that 100% tax-free growth all the way to 2047. So if I put 100K in and in 10 years, it's worth $1 million in an asset, what does it look like by 2047? And the nice thing about it is I can roll in and out of assets that entire duration as long as I'm not physically exiting the fund. So the fund can sell an asset, it can receive a distribution back on that, it can distribute out to me, but as long as I'm not physically selling my initial basis position into the fund, that original 100K, I'm good to go. I can ride through 2047. Additionally, comparing this to the current situation with the 1031 exchange market, and yes, there is a lot of news regarding 1031s and the possibility with the political nature of where things are at and where that's going to be at in very short order. The reality is that the legislation that gave us this program already was the first death blow to the 1031 program. And that's because it did away with everything else that 1031s can do other than real estate. Now real estate's up on the chopping block. So this is a program that's designed to move the money into the Opportunity Zone Fund program versus the 1031. Well, why do I want to do that if, you know, the benefit of the 1031 is I can 1031, 1031, 1031, and eventually my heirs get a step up in basis and I don't pay any tax on that property in my lifetime. Well, you still get the same benefits with that, with this program. See, with this program, and we would compare the two between a 1031 and the Opportunity Zone program, there's some similarities, but there's also some major differences and a lot more benefits with this program than the 1031. Benefit number one is I don't have 1031 exchange intermediary fees. Benefit number two, I don't have to roll the principal in. I can actually pull and extract the principal out, reuse the principal on my asset and anything else that I want, and then only invest the gains into the fund. Number three, my heirs get a full step up in basis if I were to pass away while I've invested into an Opportunity Zone fund. So in that simple little example, that 100K, let's say I put 100K in, right? 10 years, so 2031, it's worth $1 million. Let's say I haven't exited, but let's say, God forbid, knock on wood, I passed away. My kids could step into my position and still not have to claim that step up in basis until 2047. So they can actually ride through for 16 years of tax-free growth on that position in the Opportunity Zone Fund. So it is significantly more beneficial than what the 1031 exchange program is, because you get access to the money in your lifetime. You can technically receive the full step up in basis in your lifetime. Your heirs still get all the benefits. You're not subject to a 45-day window of having to find a new asset or have a failed exchange, and you get your principal back. So they're similar, but this program outweighs the benefits of the 1031 exchange program by a mile. Additionally, when you have capital gains and you roll capital gains into the Opportunity Zone Fund, this program is not like the 1031 where I've got to have a similar like kind exchange. I can have the sale of gains from a real estate, or let's say a business or crypto or anything. Actually, the reality is it's anything that creates a capital gain. So I could sell art, I could sell any type of asset that creates a capital gain for me. And then I don't have to find something similar with this program. So I can go from crypto into real estate. I can go from real estate into business. I can go from business into real estate. I got a number of different ways where I'm not subject to a similar size, scope, and nature as far as a like kind exchange. So this program is designed to move literally, because there's no cap on it. All right. It's designed to move potentially the entire weight of the US capital gain market each year. So that market space you're talking is in excess of $8 trillion a year of eligible capital gains for this particular program. Moreover, because of the fact that you look at the designated opportunity zones are not going to change now over the next 10 years because they're built on census tract data. And we just got new census tract data earlier this past year. So the next change isn't going to be really for another 10 years, which means that the assets in these zones are limited, number one, which means that the value proposition on them should be a lot better long-term because of supply demand as more money moves into this program and looks for assets. Since you only have 25% designated zones per state, those assets are going to ultimately become pretty valuable over time. So this fundamentally is a community revitalization and job creation program. That's the idea. It's a four-pronged program. It's community revitalization through purchasing, rehabbing real estate assets, job creation for businesses creating jobs. It's also a safe neighborhood program, which is a little bit more on the municipality side than it is on what I call the street, meaning you, me, people that are using this program. And then also workforce development. So it's a very, very incentivized program. And it's not just an IRS program, right? What a lot of people don't realize is that there are over 300 federal programs that support the Opportunity Zone program. This was 22 federal agencies. This was the entire weight of the federal government making a shift for the first time in our history. This is literally, guys, this is the largest economic development tool ever in the history of our country, ever. And this will be either the biggest tax giveaway or it'll be the biggest economic development tool to actually be utilized in our country because it impacts all 50 states. It impacts both real estate and business. It's a very long-term natured program. We're only 3 years into it. And the reality of it is because of everything that happened with 2020 and COVID, we were set back by a year. So we're still very, very early on in this program. And 2021 is already starting to show it's a stellar year already. There's been billions and billions of dollars that have already been reinvested into this program. And that's the beautiful thing about it is it's private. So, it's basically a self-reporting program. Anybody can take advantage of it. Anybody can technically set up their own opportunity zone fund. You can have your own gains, roll them into your own fund, and then play the game after that. But as long as you're reinvesting into what are called designated opportunity zone assets, you're good to go. And we'll kind of touch into the reporting and how assets are defined and stuff like that. But this program itself, I can't say enough about it. It is definitely going to be a major game changer. When we talk about real estate, especially like when we talk residential and commercial real estate, HUD itself has got 33 different programs for home ownership tied to opportunity zones to help people buy in opportunity zones. It's a phenomenal program. The USDA has got programs. As a matter of fact, 1/4 of all opportunity zones are considered to be rural. 1/3 of all tribal land is in opportunity zones, which means that tribal nations can take advantage of this as well. So it is a wide open program for anybody with capital gain money to be able to take advantage of. You just have a few rules that you've got to be cognizantly aware of. And so what are those rules? So they're pretty simple. Rule number 1 is everything starts and stops at the opportunity zone fund. All right. There is not a single benefit that is given to anybody who has sold a property and has capital gains and just buys another property in a zone. All right. They get no benefit. The money has to go into a fund. The fund registers and reports to the IRS that John Doe invested. The fund bought XYZ property. All right. And then that's how everything gets reported. So money goes into the fund, which means the fund is the be all end all. That's the starting point. Rule number 2 is you have assets. So assets are defined by number 1, are they in an opportunity zone or not? Okay. So all the opportunity zone again it's a geographic area. All right. So think census tracts in each state, and then everything in those census tracts, all real estate, all businesses start out as being eligible assets. And then there's a little bit of extra eligibility criteria, such as for real estate, whether you are originally using the property or whether you're substantially improving it. So this program is designed to do both. All right. If you're going to do a ground up development, or if the property has been vacant for 18 months or longer, all right, it's considered to be original use versus substantial improvement. Now, what does that mean, or why is that important? Substantial improvement on a property has a minimum dollar amount that you have to reinvest into rehab, whereas original use does not. So the first question we look at is saying, okay, in an opportunity zone, when it comes to real estate, is it original use? Because if I'm just doing a ground up build, then I don't have a minimum dollar amount that I've got to put into rehab. If it's substantial improvement, here's the formula. All right. And I'm going to use an example to break the formula down. It is going to be your basis minus the cost of land plus $1 is your improvement. So what does that mean? Let's say that I bought something for, let's just call it again, 100,000. All right. Very simple example, so we all can kind of comprehend it. All right. Let's say in the 100,000, 20,000 was land, 80,000 was the building. All right. So I bought a building and I need to do improvement to it. I need to put $80,001 into improvement. So I got to make sure that the fund has 160, well, technically 180,001 in it, in the fund, to purchase and do the improvement on the asset. All right. So that's the big thing with substantial improvement, is that you have that basis of there's a certain amount you have to put into rehabbing it. But the substantial improvement works for whether you're rehabbing, one asset or whether you're rehabbing an entire block of assets. Doesn't matter. Same concept, same formula, no limitations other than location. Other than that, the fund has what's called a safe harbor provision. And basically the safe harbor provision is a set of time parameters that everything has to abide by. So let me kind of walk you through how these timelines work, right? Because there's a couple of them. You have a timeline for the investor, then you have a timeline for the fund, all right? The beautiful thing about this program for the timeline for the investor, especially when we're talking real estate, all right, is investors only have 180 days from the date that I sold whatever, all right, to realize a gain, to actually do something with this program. Day 181, if I had a capital gain and I didn't do anything with this program, I'm out of luck. I gotta pay the tax at the end of the year when I go and I file my taxes. I gotta pay the capital gains tax. With real estate, there's a little bit of an exception to the 180 days as an investor. And that is if I sold a piece of real estate, but I did it through a business. So look, most real estate's typically held in LLCs. So if I actually sold a piece of real estate that was held in an LLC and I receive a K1 on that at the end of the year, my timeline's a little different. I get two timelines. I can choose 180 days from the date I sold that. So let's say I sold a piece of real estate that was held by an LLC in January. That means I have till June to make an investment into the Opportunity Zone Fund, right? 180 days. However, because it was done in an LLC, I can elect to have my 180 days start from December 31. So even though I sold the property in January of, let's say, 2021, I don't have to make an investment until June of 2022 with, let's say, that 100K, right? So I sold a property. And so that's how that works for the LLCs with real estate. That's the investor time clock. If it's not an LLC where I'm receiving a K1, I get no special time considerations. It's a flat 180 days, and that includes holidays. So I don't get, extra days just because a holiday was in that mix, just 180 days period. All right. Once the investment is made into an Opportunity Zone Fund, whether I'm just investing in one as a passive investor. So I sold a property and I found a fund and I liked what the assets were that the fund was going to reinvest that money into, or whether I just set up my own fund and I put that money into my own fund. And then I have, right, as a fund, I have 180 days to identify and or deploy. What does that mean? It means that I've got to find something. And if I find something, as long as I have at least a development construction schedule, if I'm doing substantial improvement or ground up, I can have what are called safe harbor provisions that gives me an extra 31 months. So it gives me, for real estate deals, it gives me 37 months altogether with the Opportunity Zone Fund to complete that transaction. Meaning that if I took 100K in, I got to put 100K out in that 37 months into new assets, real estate assets. If it's business, so maybe I sold a piece of property, got the 100K, rolled into my fund. Maybe I find a business that I want to invest into. All right. Then I have 66 months to do that. So I have a lot longer period of time. As far as how or what the assets are that the fund is investing into, it's really only three type of things or assets. All right. A, zone stock, meaning I found a business like a C Corp, and I'm literally just taking the 100K in a fund and I'm buying stock, just it's privately held stock, not publicly traded. Okay. Will there be a market for publicly traded? Yes. Is it already beginning to get established? Yes. Is it fully set up yet? No. Give it a couple more years and you'll be able to do that. But buying stock. Second thing is buying into a partnership. So an LLC, an LP, I can invest for equity that way. The third and a little less common is where the fund itself directly owns the asset. So in that example where I had that $100,000 and I sold a property and I rolled into a fund, more than likely what's going to happen with real estate is the fund will invest that into an LLC, and that LLC will then pick up the property instead of the fund itself directly buying the property. The reason being is because the LLC gets a little extra benefits than the fund directly, and they have a longer safe harbor provision. So it makes it a little bit easier for the fund to operate and meet compliance. So, and regarding compliance, every 6 months, the asset has to meet compliance testing. So, and it's all self-reporting. So what does that mean? Just means that, I'm going to certify on a tax form that my assets in an opportunity zone, the address says, hey, you're in this designated tract, that I invested X number of dollars, that my asset has, X number of either jobs that were created if it was a business, X number of employees' hours worked. If it's a business, 70% of my tangible assets have to be owned or used in the course of that opportunity zone business. If it's real estate, you don't really have those type of asset type considerations because the asset itself is the real estate in an opportunity zone. But that's the program. This program also has several different extensions that are up in Congress right now, one of which is a 2-year extension on the tax deferment. So when I have a capital gain, I sell property today, I've got that 180 days. And we talked about when I do that, I'm deferring paying the capital gains tax for tax year 2021. I'm deferring that out to tax year 2026. The legislation that's up in front of Congress right now, and it will pass. It will probably pass sometime in the next, I'm anticipating probably 30 to 60 days. We'll see this come through. But it's going to give a 2-year extension to that 2026 tax deadline, pushing my tax bill out not due until 2028, tax year 2029, or fiscal year 2029, tax year 2028. Additionally, it's going to actually retroactively bring back an extra 5% step up in my basis. Remember, one of the 3 benefits I get to defer, reduce, and eliminate my taxes on my capital gains. That second benefit, that reduction, I'm getting that 10% step up in basis because between 2021 and 2026, it's a 5-year window. And that 10% step up in basis, I'm eligible for that because I've held my investment for 5 years in that fund. So by default, between now and 2026, I get that 10%. This is actually going to give me an extra 5%, bringing me up to a 15% basis. So instead of paying tax on 90, I would pay tax now on 85,000 on that $100,000 example. So that's the real big benefit with this. The second legislation that's in front of Congress is actually to extend the overall program itself by 10 more years, pushing all the deadlines out by a 10-year extension. So going from an expiration of 2047 to an expiration of 2057, an expiration of 2037 for investors to 2047. So the 2037 expiration for investors who have capital gains have until December 31, 2037 altogether. So for the next 16 years, each year, any capital gains can be reinvested into an opportunity zone fund. All right. That's more than likely going to be extended as well. Moreover, Congress is also looking at taking this and actually programmatically splitting it up and doing carving out additional niche benefits for different industries. So hemp, solar, green, clean energy. We may see cannabis in there eventually at some point in time in the future. But like, for example, right now, there's additional state benefits that somebody can get if a business is hemp related. So there's more ancillary benefits. Also, when we talk about benefits, besides just I'm an investor and I sold a property and I've got 100,000 and great, fine, I rolled into a fund. The fund is actually tax stackable with benefits. So what that means is that all of like my low income housing tax credits, my new market tax credits, my solar, my historic, I mean, everything that an asset, something in an opportunity zone would be eligible for stacks with this program. So I can, as an investor, think about this scenario for a second. Let me kind of paint you what I mean by this scenario, right? Let's say that I sold a property and I had 100K and I put it into the fund, right? The fund finds an asset that's in an opportunity zone, and maybe it's eligible for TIF credits. Maybe it's eligible for TIFs from the municipality, maybe state benefits, and then maybe some low-income housing tax credits. I can get at the asset level, the asset can take all of that and then still be able to pass those benefits on to me as the investor, because I'm going to get my yield at a higher rate because all of the benefits that are in that asset. So it is a really a unique program. It's kind of a one-off animal, actually, in our government. We've got 1,000 pages of legislation that back this. We've had 2 sets of tranches. But this is a massive, massive program that is absolutely designed to fundamentally landscape change, our country, starting with these designated opportunity zones. And it can easily see being expanded over time as this program really bears fruit and shows itself. But up to this point, over 1,000 opportunity zone funds have already been created across the country. The White House did an announcement back in November that at that point in time, over 75 billion has already been invested into the program. So, and that's a drop in the bucket when we compare to how much capital gain money, actually exists each year. 2017, there was $6.4 trillion in US capital gains. 2018, it was 6.8. 2019, it was 7.2. Keep going, right? We're only going up and up and up with capital gains. I mean, we look at crypto capital gains. We look at the stock markets, capital gains. We look at real estate property values, capital gains. This whole thing is designed to shift the capital gain money away from taking advantage of 1031s and other programs like that and put it into privatizing economic development between you and me, being privately giving you and me federal tax benefits, and in all but 5 states, state tax benefits on wealth. Because at the state level, I get to defer, reduce, and ultimately eliminate, just like I do at the federal tax level. So this is a massive, massive, massive tax program. And it impacts 85% of the whole program right now is impacting real estate. Real estate was the absolute launching catapult aspect of this program. And a lot of people are like, well, it's opportunity zones. They're low income. They're not going to find good assets. That's a bunch of BS. All right. There are plenty of phenomenal assets in opportunity zones. And even though that they've got the moniker of being low income, you cannot tell me that Fairfax, Virginia, the second wealthiest county in the nation that has opportunity zones with $1 million properties in them, should be designated as an opportunity zone. Reality is that because this was political in nature and how everything kind of trickled down, it started at the top, and then the assignment was given from the federal government to all of the state CEO and the state governors. And the assignment was review your zones and either expand or subtract. And then that was then passed down to the local municipalities to review the zones to either expand or subtract. And then the municipalities gave that back to the state, which then added and subtracted, and then gave it back to the government for approval. So we kind of had a starting point that went from the top down and then from the bottom back up. But this is a program where everything about it is designed to be private for you, me, private people to take advantage of, but it's not going anywhere and it's only getting bigger. And so that's a little bit about opportunity zones, a little about the background on it. I can dive into a bunch of details and questions, which Carl would probably be a good thing if we opened up and did some kind of Q&A, because there's a lot of explanation that will kind of come from use case examples and stuff.
Yeah, and I've heard this before, but it's a lot of information. And
it is a lot of information.
It's a lot of information. Also, too, if any of you are on Clubhouse, the app, there is a David's team runs a group called the Opportunity Zone Fund Club, and they go live they have rooms all the time where they unpack this even more. So if you're on Clubhouse, definitely follow David, get into his rooms. There's so much information in there. But does anybody have any questions?
I do, and I think David covered it, but I just wanted to be clear about it. To open an Opportunity Zone account, basically, the funds can come from anywhere, or do the funds have to come from a profit of another dealing?
All right, it's a great question. All right, so it's two answers to answer your question the right way. All right, technically, to set up an Opportunity Zone fund, a fund is either a C Corp, an LLC, or an LP. Okay, that's what a fund is. It's a brand new entity as a fund established after December 31, 2017. Okay, it's not going to be public. It's going to be private. Okay, you have two types of funds that exist out there then as a result of being an LLC, LP, or C Corp. You have a closed fund, you have an open fund. The difference is this, all right? A closed fund typically is a result of somebody who had sold an asset, has capital gains, wants to be an active investor with this program. And so they're setting up their own fund to roll their own gains into so they maintain control of the money, okay? The only contingency is that they have to reinvest it into assets. That's a closed fund, right? An open fund, Rocco's a little different, right? An open fund is still going to be an LLC, C Corp, and LP. The difference is that it's opening itself up to outside capital gain investors to also invest into that fund, typically more as a passive investor, which means, let's say, Rocco, you found an asset and you set up a company and you're like, this is where we want to invest that money into, okay? Maybe you rolled some of your own gains to get kind of it going, but you opened it up and you're allowing me and Carl and anybody else on here to invest with you into that asset through your fund, right? That fund then is going to then fall under all of your Securities and Exchange Commission rules. So you're going to need to have a private placement memorandum. You're going to do some sort of structured offering, whether it's a Reg B offering, a Reg C offering, a Reg D offering, term sheet, sub agreement. There's a regimented process to set that up to raise money from people you don't know. They also are typically going to be third-party administered. They're going to typically have a yearly audit at the end of the year, so that way investors know. So closed, open, kind of depends on what you're trying to do. If you're setting up a closed fund, as long as if you're setting it up, and most closed funds are typically, like I said, they're usually going to just be an LLC, right? Set up an LLC, set up in Delaware. The big thing you got to be aware of is the operating agreement for the closed fund and your safe harbor provisions for your assets, all right? The statute for this program is IRC 1400 Z2. And that statute is very, very clear that your operating agreement for your new entity has to state in that operating agreement, our intention is to operate as an Opportunity Zone fund, okay? Once you set it up, you're going to have to pick a start date after you set the fund up, okay? Most start dates are usually like July 1 for most funds, because you have 6 months and then you pick your start date and you have another 6 months before you got to do your first actual reporting, okay? Once you set it up and you pick your start date, then the fund itself is going to file what's called an 8996 tax form. It's self-reported. So you go to any tax professional. Our company can help you guys, anybody out with those as well. All right. And it's basically just going to let the IRS know that, hey, we're operating and registering as an Opportunity Zone fund. Beyond that, you don't have to register. There's no approval. It's not like the IRS is going to come back and say, sorry, no, you don't qualify, or no, you can't set it up. There's no max. There's no minimum. There's none of that. All right. It's just a tax form notifying, saying our name, who's invested, what's invested, where it's being invested into. even if you haven't invested the money yet into the asset, even if all you've done is pick an address out and you kind of know the details about it, but you haven't actually stroked that check yet, that's good enough. So it's just simply identifying. Second thing is your safe harbors. Okay. Safe harbor provisions. It's a fancy way of saying use of proceeds. All right. And that's the big thing with real estate. So if I'm developing out, whether I'm doing ground up or I'm rehabbing a property, Uncle Sam wants to identify through 11 questions, 11 safe harbor questions. If you put $1 million in, how were you spending $1 million? How much of that money was used to acquire? How much of that was used to, develop? There's 11 set questions. I can go through them, but it'd probably just be easier for you guys to go to opportunityzones.org. And we break all that stuff down in some free ebooks and things like that you can kind of look at for the rules, regulations, et cetera, for opportunity zones. But that's it. It's 11 questions. Your safe harbors are broken up over 36 months. So you're going to figure them for 3 years, month by month. So January, it's going to, $5,000 to identify a property. February, $5,000 to identify, and you tally it up. That's your big thing you got to know is your safe harbors the moment that you pick an address, because that's what gives the fund all the necessary time to actually deploy the money. Otherwise, that fund would have to do everything in 180 days. So safe harbors are critical to this program for both business and real estate. Same questions apply to business too. They're not different safe harbor questions. They're 11 universal questions.
Hey, David, I have a quick question. So if there's a fund and you're managing a property through it, what happens with all the rental income? Is it disposable? Can you use it? Does it have to stay in the fund? What happens with?
Oh no, it can. Oh no, you can absolutely have a property cash flow, distribute that out to the investors in the fund. You could, just like you don't have to. Here's the thing, you don't have to even hold the property for 10 years. Okay, you can actually buy a property and flip it in 3. All you're doing is you're reinvesting that money into a new asset. That's all. Any cash flow can be distributed out. If the fund's an LLC, it's going to K1 to the investor.
So you could flip a property and then take the proceeds from that and put into something else in the opportunity zone and just keep it moving. Absolutely.
All of the hold time periods, when we talk the 10-year time period, everything, it's on the investor. It's not on the asset. That's a little bit of the confusion with property on this. All right. It's all about, for Dave Silliman, how long is Dave Silliman maintaining an equity position in this opportunity zone fund? Not even an equity position in the asset, just the fund. Because remember, the fund is its own entity. So if it's set up as an LLC and I'm a limited, unit holder in that, as long as I'm not selling or exiting my limited position in the 10 years, I'm good to go. The fund assets can churn and burn over and over and over again, all the way to 2047.
Got it. Oh, that's good. We have another question. Who manages the accounts? Is it like in a 1031 exchange company?
No. See, with 1031, when I have capital gains, I'm putting my money into basically a holding escrow account with an exchange intermediary, and I'm paying, for them to hold that for this. This is actually, I'm holding my money. There's going to be an administrator usually that will make sure that for documentation purposes that everything is being documented the right way for any outside investors. But if my fund is a closed fund where maybe it's just myself and another person and it's our capital gains, we just, transferring of one bank to another bank with our names on it. And then from there, we still maintain control.
Okay. Chris Barrett, you have your hand raised? Do you have a question? Do you want to unmute yourself?
I think I raised my hand. I was just playing around.
Oh, all right. No problem. Does anyone else have?
Does this have to be set up before the closing of an asset? Yes. Yes, it does. All right. you want to make sure that before you close on any sort of assets, if you've got capital gains, otherwise the fund won't be the one purchasing the asset if you've already closed on the asset, which means that the asset won't be an eligible asset. So if I've realized a capital gain, so I sold something, let's say I sold a property and I got that 100K example, right? I need to set up my closed fund or my open fund, depending on what I'm doing. I need to do that first, put the money into the fund, then use the fund to close on the asset.
So my other
there-
question is, could you deep dive too with the, no, not deep dive, but the business aspect? So let's just say you have capital gains, you set up the fund, you buy a business. Does all the business have to be done in the Opportunity Zone fund, or does it just have to be headquartered in the Opportunity Zone
Okay,
fund?
great question. All right. The way that businesses work is the business address itself does need to be headquartered in an Opportunity Zone. All right. The Opportunity Fund does not, but the assets do. Okay. The business will be headquartered. The business is going to be looked at based on the number of hours worked by its employees. It's going to be looked at based on the number of hours worked by its executive team. It's going to be looked at based on the assets that the business holds. And it's going to be looked at on its non-qualifying financial property. So cash, things like that. All right. As a business, you have a few things that are called sin businesses that you cannot invest into. Beyond that, everything else is eligible. Okay. I cannot invest into strip clubs. I cannot invest into massage parlors, sun tanning type stuff, massage clubs. All right. I cannot invest into like an ABC type store. I can invest up to 30% into a casino. Other than that, everything else is on the table, including cannabis, crypto, mining, all of it is all eligible. It's all being done in the Opportunity Zone space right now. And also, I want to add this too, Carl, if I can. When the fund makes an equity position, remember, everything is equity with this, all right? You can leverage the assets, all right, to create exits. You can refinance the assets. You can flip assets, but everything else is all equity. So as an investor, I'm equity into the fund. Fund is equity into the asset. When it comes to a business, again, there's no max, there's no minimum. So it's not like the fund has to be the majority equity holder of the business. The fund could come in as just a little fraction of a percentage point if it wanted to, if the business was good enough. It's all relative. But the idea is that that business should, spur job creation in that Opportunity Zone.
Okay. We have a question. Can it be used from New Jersey asset to another state?
Absolutely. Absolutely. And that's the difference with this, right? I mean, I can sell an asset in New Jersey and I can freaking invest in Guam if I wanted to. Puerto Rico. All right. Puerto Rico is a big one because you've got all of your Act 16, your Puerto Rico benefits for capital gains for investors between Act 20 and 22 that were combined. So Puerto Rico is a big safe haven right now for this program. It's really, this year is the year that Puerto Rico seems to be kind of taking off, but Virgin Islands, Guam, you can invest in any state. All 50 states have Opportunity Zones. All of them do.
And where can people go find the Opportunity Zone maps?
Easiest way is just go to opportunityzones.org. We actually have it's right there in the menu. There's a map, and all you do is just type your address in. And when you type the address in, if it pulls up and the area is kind of a pinkish color, guess what? You're in an Opportunity Zone. If not, then you're not.
And I just want to remind everyone on this call as agents, right? We cannot represent that we are accountants or attorneys or experts in this. So I just want everybody to have a good overview and then be able to direct the person they're working with, or if they're doing it personally, to an expert or somebody who knows how to get it set up, just for a lot of liability reasons.
Yeah, we're a team of 28 professionals all together now. We've got 6 different attorneys on staff, ranging from tax, real estate, corporate, financial, and securities. This is definitely something that whether you're setting up an open fund or whether you're setting up a closed fund, take the time to consult with somebody to just walk you through it, make sure that you're doing everything the right way, get educated enough on understanding, especially if you're going to set one up and you're going to be an active in it, which is, I encourage everybody to be active with it, right? Know how to play the game, because if you miss compliance, you only have one reporting cycle to get yourself back into compliance. And if you don't, then it means that your fund is out of compliance, which means that your capital gain is no longer eligible for all the tax benefits. So if the fund loses compliance, as an investor, you lose compliance. So compliance on this is very, very important, on understanding exactly how it works and understanding exactly how you're going to play the game. But it's not a difficult game to play once you understand it. It's just identifying the assets, keeping track of your costs, which should be a given already, and, you know, self-reporting every 6 months.
Does anyone have any other questions? I mean, if you do, there's no dumb questions. I mean, as you can tell, David is a wealth of knowledge. That's why we brought him in on Opportunity Zone Fund. So please feel free to ask any other questions.
Sure, I got a question, Carl.
Yeah.
Hi, David. I'm Daryl Bailey. I'm on your Clubhouse group as well every weekend. So thanks very much
awesome.
for that. So quick question for Open Fund. Am I only allowed to accept funding from institutionalized investors?
No.
And then the second question, am I allowed to accept funds from overseas investors?
Great question. All right. Number one, when you set up an Open Opportunity Zone Fund, obviously you're going to have a private placement memorandum. All right. If that is done and built the right way, you can take all of that information and you can pitch it out, and institutional investors can invest. But so can retail investors. I mean, you can have an Open Opportunity Zone Fund and you and I might be friends, and I've got capital gains from selling crypto, and I can invest into your fund without having to go through an institution or paying broker dealer fees or paying any of that kind of stuff. As a matter of fact, I can invest and have no fees for investing into your fund. As far as your second question for foreign investors, all right, the fund technically can take any investment money in. All right. It's not just capital gains. What happens is on the books, capital gain money is delineated differently and non-capital gain money is delineated differently. Okay. So I might be an investor where I might have 100K in capital gain on 100K in non-capital gain, but I put 200K into your fund. My 100K of capital gain, I will pay no tax on. Any increase on that, I pay no tax on. The 100K of non-capital gain money, any increase on that, I'm responsible for taxes on, right? For foreign investors, if I'm a foreign investor and I pay US taxes and I've got US capital gains, I can absolutely take advantage of this program, all right? If I'm a foreign investor and I don't pay US taxes and I have no US capital gains, there's really no major benefit to this program other than potentially maybe the yield on whatever the underlying asset investment might be. But it'll pop, you know, it'll make me subject to US capital gains tax at that point.
Yeah. Okay, lovely. Last quick question, David. So the metrics that's going to be used by the IRS to confirm the impact in regards to being able to prove that you've created impact in these areas. How are they going to go about that in regards to making sure that—
It's $1 million question. I say that because the 8996 tax form has already been updated about a half a dozen times just since we got it a little over a year and a half ago. Okay. This is really important. This is just something for you guys all understanding on this program, especially for moms out there. You'll really understand and kind of relate to this, right? This program was like giving birth to a child that was born too early and that stayed in the hospital for the first 18 months of its life, then came home. And in the first 30 days or 90 days of coming home, the world went through COVID. And that's this program in a nutshell. So there's still a lot of like questions. And that's the big thing with the current Biden administration that they've been very publicly about, you know, coming out and saying is, listen, we love the program, but we want enhanced reporting so that we actually know whether it's working or not. Up to this point, the 8996 form has changed, like I said, a half a dozen times. So and you still have funds that haven't even done their first reporting. So it's a little too early to fully gauge just where this is at right now. The information that we're getting is a little bit out of the IRS for what has reported, and the rest of it has been from Form D filings with the SEC on open funds. And that only gives us an idea of how much has been invested, which gives us a baseline of what's going to be reinvested, whether it's already been reinvested yet or not. It still gives us a baseline. If we know that, 100 million's in opportunity zone funds, then we know that 100 million is going to end up being reinvested, as an example. So as far as the number of jobs, as far as economic impact, as far as anything, none of those enhanced reporting requirements are in the 8996 tax forms yet, but they're coming.